Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. 20 weeks ago I highlighted a bright pink July 2024 to date rectangle pattern, currently at 958 to 1099. This pattern is still operational even now. The top side of this pattern is also capped by the nearby 50% Fibonacci line, the May to August 2024 move at 1098, and the 61.8% absolute Fibonacci line at 1106. Nearer term, the market over late April and early May had tried to stabilize over the November 2020 low at 1045 and looked for a while like it might try higher. But over mid-May and then mid-June, we could see a capping action symbolized by the bright red, fairly flattish upper trend line on my daily chart, currently at 1084, which ended up being a May to June based double top. More on this shortly. At the same time, the basis of the very recent action since late April also lined up into a lower trend line, currently at 1007. Together they made up an expanding wedge pattern that last week breached on the downside, though prices have seemingly failed to fully stabilize below this bright red trend line. This is still the immediate pattern to look to right now. 2 weeks ago, I commented on this thus, and I said, and I quote, "So, whilst it is a bit early, I still thought it appropriate to set up some potential targets below for the bright red expanding wedge pattern. Thus, a primary target X would be in the 991 zone, tying in with the lows of March and April, whilst a secondary, harder to reach target X1 will be down in the 944 zone, tying in with the September 2020 low at 942 and the August last year low at 940, end of quote. Last week, prices reached down to target X, down in the 991 zone, as well as the primary target for the earlier mentioned double top at 994. However, the market pulled up away from target X once it was achieved, and back up over the bright red lower trend line. I also said last week, and I quote, "I'd also keep a wary eye topside on the long moving average," and that's currently at 1027, end of quote. And that proved to be the case, as it capped the rise late last week before we started edging lower once more. A further feature highlighted on my daily chart, and an important one, is the dark blue late December 24 to early April 25 bullish shift pitchfork. 2 weeks ago, prices punched down and closed below the lower time, currently at 1023. However, last week we moved up and retested the dark blue lower time, and it is easy to see that whilst the gold long moving average overhead capped the rise, the dark blue breached lower time, eroded the bullish incentive at the time for close right on it last Friday. Now, it's not unusual to see a market run along the underside of a breached lower time, so watch out for that. Yeah, if all the other patterns and pressures think this might not be the case here, so just keep an eye on the dark blue breached lower time, but keep a closer eye on the breached bright red lower trend line. Chicago soybean meal. 15 weeks ago I linked some of the recent highs into a bright red downtrend, currently 286.5. That tied in nicely back then for a while with the descending long moving average, currently 298.30. The long moving average was then just about shadowing the downtrend, but a little higher up, and with the medium moving average currently at 293.40, which earlier had failed to provide much resistance above, but then energized itself as a resistance, and quite a good one, over mid-May to mid-June. Now, 9 weeks ago, we had a clear close over the bright red downtrend, and prices tried to stabilize over this breached, possibly broken downtrend. However, the bears out there really relied on the overhead medium moving average to cap the market's rise back then, and so it did. This breach on the upside was just a breach and not a break higher, and separately, I was not impressed with the lack of any significant bullish incentive at the time. All this impinged on my thoughts from 17 weeks ago as to whether the whole action this year had developed into a type of descending triangle pattern, morphing into a descending wedge pattern, with the bright red downtrend topside being the upper trend line and the 290 even level below being the base for the descending triangle, whilst importantly the early January to date purple lower trend line, which is currently at 282.40, was the lower trend line for the descending wedge pattern. I said 7 weeks ago, and I quote, "For the future, I think a lot will depend on any move down below 290 even, to verify if it all will be a descending triangle or descending wedge pattern, or on any true break above the seemingly resilient overhead medium moving average, and ideally over the long moving average just above that for any significant move higher." End of quote. I also added that my major concern is the same as it has been now for 17 weeks here, and it is as I warned back then and since, and I quote, "possible false breaks here out of this proposed descending triangle pattern." End of quote. 5 weeks ago, prices broke down through the 290 even zone, the lower support for a descending triangle pattern, and 4 weeks ago they broke down through the purple lower trend line for the descending wedge pattern. The market seemingly stabilized below this latter one, and it was enough for me 3 weeks ago to set out some possible targets below for both patterns on the downside. Thus, for the descending triangle pattern, we had a primary target in the 273.20 zone, with a secondary, harder to reach target, X down at 255.60. For the descending wedge pattern, we had a primary target in the 272.30 zone, with a harder to reach secondary target X1 down in the 242.80 zone. As you can see, both primary targets for the descending triangle pattern and the descending wedge pattern have been achieved, just leaving the harder, in some cases much harder to reach secondary targets further down. This leads to the somewhat reactionary move back up seen 3 weeks ago, and the other one seen last week and this. It raised the question once again as to whether this break low was yet another false break, but this time on the downside. Such an action is indeed something we see on occasion, or breaks lower to descending wedge patterns, a dip that will swiftly revert higher and maybe start a new bullish move. It all created a weekly key reversal up last week based from the combination of the 50% absolute Fibonacci line at 272.10 and the April 2016 low at 268.5. Now despite this reactionary move back up, we've not as yet seen such a dip. Just a recent aberration on the upside, and prices still remain below both the purple lower trend line and the significant 290 even level. Thus for now, we'll continue with targets X and X1 below. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also now resonates into 2025. And that is the annual key reversal seen here at the end of 2023. I said I'm afraid I have to repeat something I've now highlighted for 111 weeks, yes, well over 2 years. And I quote, "I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we have been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "If there is only one thing you take away from any of my musings, let it have been those words." End of quote. These last few weeks have shown that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean oil. 5 weeks ago we had a gapping move higher that punched up and out of the earlier showrunner here, which is a shallow bullish shift pitch hawk for the mid-September to late December 2024 move. 4 weeks ago we stabilized over the upper tine, and 3 weeks ago prices pushed higher over the 50% Fibonacci line of the March 20 to April 22 move at 56.34, with a small gapping move higher since filled in. We then had a smaller high in very early July, but following this, prices utilized the 50% Fibonacci line at 53.59 as a base for the move higher. This 50% Fibonacci line is quite interesting as it's a gateway to overhead congestion that stretches from 56.34 till at least the top of my daily chart in the 59.44 area. All this action caused a monthly key reversal up here for June, and I have earlier in my soybeans commentary in recent weeks mentioned the imagery we have with a monthly key reversal up here in June whilst having a monthly key reversal down in soybean futures contracts all at the same time. This leads me to what may be the most or the more dominant pattern right here, and one I mentioned 6 weeks ago. It was, as I said at the time, and I quote, a new pattern emerged over the last month or so, and one that I warned may kick off 2 weeks ago. So that's now 8 weeks ago. And has actually done so since, though the break has not fully stabilized as yet. It is the dark blue start of April to end of May ascending wedge pattern. Currently 50.66 up to 58.58. This pattern has the appropriate number of touches on each side, and back late 8 weeks ago had a brilliant breach and break lower. But as I said 7 weeks ago, and I quote, clear consecutive closes below this dark blue lower trend line and I would feel obliged to lay out potentials and even possible targets below for this pattern. Something I'm not confident in doing just yet as I fear a possible false break lower, end of quote. Well, since then this pattern has repaired itself and we are back well within and climbing higher after June's monthly key reversal up. Thus we are starting to enter the overhead congestion stretching from 56.34 to 59.44. There is one other feature I'd like to draw your attention to. It's the possibility that the lows of April and June coming together to form a new lower trend line, currently at 47.49, highlighted in bright green on my daily chart. A new lower trend line to the original ascending expanding wedge pattern. I have still not fully explored this idea as yet, but I do feel obliged to lodge it in your and my mind just in case.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.